All right, let's dive straight into this explainer. Today, we're going to literally drop you right onto the trading floor of Wall Street in 1929. We're going to experience a historical, financial thriller over a single, absolutely devastating 24-hour period. We'll be looking closely at the actual mechanics of a financial collapse, but not from some boring, high-level historical view. No, we're going to look at it from the perspective of someone standing right there on the trading floor, breathing in the panic.
So ask yourself this. What would you actually do if your entire life savings became a massive debt in just 24 hours? Let's set the scene. It's 8:30 a.m. on Wall Street. You arrive carrying what you believe is an absolute fortune. Your broker told you the market always recovers, right? Your friends are bragging about getting rich. The papers are packed with stories of regular people buying new cars, radios, houses, the whole 9 yards. But here's the kicker. You aren't a pro. You're a clerk with some savings, an incredibly dangerous margin account, and honestly, a whole lot of completely unearned confidence.
Part 1. The morning of borrowed money. It's early, and you're firmly convinced you're just one good trade away from total financial freedom. But there's a hidden trap lurking in your portfolio. Take a look at this breakdown. It completely exposes your vulnerability right now. See that tiny sliver? That's your actual cash. Back in the late 1920s, you could put down roughly 10% of your own money and just finance the remaining 90%. You bought on margin. So you walked in thinking you owned $100 of stock, but in reality, you just own a razor-thin layer of protection sitting on top of a massive mountain of debt.
And this brings us right to the double-edged sword known as leverage. Now, leverage feels incredible when prices are going up, right? It supercharges your gains. But the math works exactly the same way in reverse. Think about it. If a $100 stock falls to $90, the company only lost 10% of its value. But since you only put down $10 of your own cash, that $10 drop means your personal equity is entirely wiped out. Your little shield just vanished, leaving you holding nothing but that massive debt.
Let's move to our ticking clock. Fast forward to 10 a.m. The opening bell rings and bam! The trading floor instantly turns into a madhouse. Brokers are screaming, messengers are literally sprinting across the room, phones are ringing off the hook. The prices are supposed to appear on the ticker tape, but the trading volume is so insane that the physical tape just cannot keep up. So you can't even see the market in real time. You're reacting to information that's already hours old. Which brings us to part 2, midday, and the dreaded margin call. By noon, reality is biting hard. The stock you proudly bought at $90 is suddenly hovering near $80. You're making decisions based purely on hope. Out of nowhere, a clerk practically shoves a slip of paper into your hand. It's a margin call. They're demanding you deposit more cash right this second. See, if your account drops too far, the broker steps in to protect their loan. They don't care about your portfolio. If you don't add money, they'll sell your shares without even asking. But you don't have the cash. Your savings are already tied up. You think about borrowing from family or maybe just waiting it out. But guess what? The market literally does not wait. So the crucial thing to understand here is this doom loop that kicks in. Forced selling feeds more forced selling. The falling prices trigger margin calls. Those margin calls trigger forced sales, and those forced sales push the prices even lower, which, you guessed it, triggers the very next round of margin calls. A bad day mechanically transforms into a relentless self-feeding machine that just won't stop. Part 3. Afternoon, contagion, and panic. As the afternoon drags on, the whole nature of the problem shifts. We're no longer talking about one bad company or a rough sector. Trust is completely evaporated across the entire market. You're staring at those delayed numbers on the ticker tape, and a terrifying realization hits you. Market panic isn't just fear. It's fear on steroids, fueled by heavily borrowed money and colliding with incomplete information. The crowd is in an absolute frenzy, reacting to prices that probably don't even exist anymore. Finally, by hour 8, you throw in the towel and decide to sell. But, surprise, your broker already sold part of your account to protect himself. And here is where you learn a very brutal lesson about liquidation. In a crisis, you are actually forced to sell your best assets first. Why? Because in a total panic, the good stuff is the only thing that can actually find a buyer. You're liquidating your winners just to cover the garbage. You walked in only thinking about profits, and you never once bothered to plan your exit.
Part 4. Nightfall. The real losses. The closing bell finally rings, but honestly, your personal nightmare is just starting. You step outside into crowds of completely devastated people, all trying to figure out where their money went.
And it's here that you realize something profound as you watch the few guys who actually survived the day. Their secret? Cash reserves. They have the flexibility to just wait. You had zero cash because you thought uninvested money was lazy money. But now you get it. Liquidity isn't laziness, it's time. It buys you the time to actually think, instead of being forced by the market to sell at the absolute bottom.
So you head home after a very tense stop at a panicked bank, and the stark reality hits you. This is the part those big success stories usually skip over. Your asset value? Yeah, that can vanish in literally minutes. But that loan balance? Oh, that loan remains 100% intact, even after the crash. You went in thinking the worst-case scenario was losing your initial investment, but because you borrowed, your losses are actually way bigger than the money you even started with.
You finally get home. The city's still lit up, restaurants are bustling, which just makes the whole disaster feel totally surreal. But then you sit down at the kitchen table to tell your family the savings are gone. And boom, the market crash becomes intensely personal. Risk isn't just a red percentage dropping on a ticker tape anymore. Risk is what happens to your actual life when that percentage becomes real. It's unpaid bills, compromised security, and real, visceral fear about rent and groceries.
Part 5. The next morning in our 5 rules for survival. Looking back, you realize your mistakes weren't because you were stupid. Not at all. They happened because you were wildly optimistic and had absolutely no safety net. Which leads us to the actionable rules you need from modern investing.
If you could do a total do-over of that day, here is the playbook you'd follow. First, never ever invest money you need for near-term survival. Second, truly respect leverage. Borrowed money turns volatility into total ruin. Third, diversify, so one bad stock doesn't tank your whole future. Fourth, keep liquidity on hand so you're never forced into selling. And fifth, define your risk before you even think about the profit. Always ask how much you can afford to lose, rather than just fantasizing about the gains. These rules don't magically stop losses, but they sure as hell prevent a single bad day from destroying your life.
And wow, did the market expose all of those weaknesses at once in 1929. The crash didn't trigger the Great Depression overnight, but man, those drops were historic. By mid-November, the Dow had lost roughly half, yes, 50% of its entire peak value.
So the ultimate takeaway of this whole explainer is really this. Wealth isn't built by perfectly predicting every single market crash. Nobody can do that. Wealth is built by structuring your finances so you can actually survive the crashes you completely fail to predict. A great asset instantly becomes toxic if you buy it with too much debt and zero survival plan.
Which leaves us with one final, pretty sobering thought to consider. Take a hard look at your own portfolio right now. Are you borrowing cash just to chase hype? Are you throwing your emergency funds into the market, copying the crowd, and just pretending the market can't drop? Because if you are, you might be stepping right back into the exact same psychological trap that wiped out a generation in a single morning. Take a look at your strategy today, and just make sure your financial house is actually built to survive tomorrow.